Hi.
Hi Devi,
Hi, Shashank. Hi. How are
very
you?
good afternoon.
Good afternoon. Very good afternoon.
We'll just wait for a few minutes.
Yeah, yeah. Sure.
Yeah. So how have you been?
All well going on.
Great, great. Maybe another 5 minutes at best. We'll wait, Devi.
Yeah, yeah. Sure. No problem. So this product has been rolled out in your system now, right? I mean, you have sent out emails, or
Yes, yes. It's already rolled out
so
through
this is
email.
largely our team, right? Our team, Pan India team.
Yeah, yeah, yeah. The coordinates have also been shared with
Okay.
your my team.
Okay. Sure.
Anybody from your fund management team also would be joining?
No, there's no one from the fund management. Actually, everyone is traveling. Even I am also traveling for a roadshow. But
Okay.
then we thought of doing it today because it gives us good enough time, in fact.
Right, right, right. So you're currently in Mumbai only.
Yeah, I'm based out of Bombay, yes.
No, no, you're based out of Bombay that I know, but
Ah,
currently you're
right,
traveling.
yeah. Right now I'm in Bombay only. I'm just, today evening I have a flight, so
Okay, Devi, we will start. So,
Okay.
friends, very good evening to all of you. Today, we have the pleasure of having with us Mr. Devi Prasad Nair. He's been in the industry for more than close to 20 years and who has had various stints across various mutual fund companies, starting his career from ABN AMRO. And then he had three different stints in ICICI Prudential AMC. He has spent some considerable time in Birla Sun Life Mutual Fund as well. Currently, he is the India business head for Helios Capital Mutual Fund. And before I say further, I would request Dev Prasad to start off. And once we are through with the NFO product that is up for discussion, we'll go in for a Q&A session. Meanwhile, during the process of the presentation, if you have any questions, please use the chat box and I'll take it up on behalf of you, all of you, with Devi Prasad. Over to you, Dev.
Thanks. Thank you, Shashank, and good evening to everyone. And thank you very much for this opportunity to engage with all of you. Really appreciate. So what I'll do is I'll quickly take you through the fund. Before getting into the fund, let me just introduce the man behind the fund house, which is Mr. Samir Arora. Samir, been a market veteran. He's in the markets and into investing for over three decades. He's IIT Delhi, and I am Cal and Wharton alumni, and he came to India in 1996 to set up the Alliance Mutual Fund practice, and then got elevated as the head of emerging Asian equities in '98, and moved to Singapore, and then when Alliance got sold in 2003, and in 2005 is when Helios Capital was founded by him. And in 2005 July, and then so Helios is a 20-year-old organization. It was operating as a hedge fund out of Singapore before we started our operations in India in 2020 through our PMS, and then we got an AIF license, and then in 2022 we got our mutual fund license, and course now as we speak. So that's briefly about the organization, and then about the other giants who are in the leadership position at Helios. Dinshaw is the CEO for India. Dinshaw has been with Samir and with Helios for a very long time. Dinshaw, uh, joined Helios from the very beginning, which was in 2005. So, and Abhay Modi is our head of research, again a veteran market participant and been in with Helios since the very beginning. Alok Behel was one down to Samir. He's the CIO for India, and he's been again with Helios since the inception. And it's myself. I've been in the industry for over 20 years, and across business verticals. In my last stint, I was heading the alternate PMS business for Helios. Sorry, for ICC Prudential, and then moved here to set up the India business for Helios Capital. Kiran is our COO and CFO, and Abhinav Kimani, who's our compliance officer. Both again, have got a long stint in their respective organizations and joined us when we had set up our mutual fund. So so. So what are we looking at Helios is that we believe that we have always done India dedicated product. We believe that India has a tremendous growth potential. It has not even grown a fraction what it can actually grow, and whatever it has done with a lot of I mean, there have been headwinds, which be it domestic political uncertainty, or be it wars, or be it global crisis, or so India as a market has steadily delivered return. If you look at the long term basis, India has not only India in dollar terms has not only Nifty 500 I'm talking about, has not only beaten the other market, it has beaten even Warren Buffett's return, right? we do share those data, we can, share that as well. But India has done very well compared to other markets, right, across, 5, 10, 15, 20-year period. And we believe that there are strong tailwinds for India, which is, be it in terms of structural growth and higher single digit growth. So India, I think it has grown, and we believe that, in next, 5, 10, 15 years, I think, India can continue to grow, essentially because, the demography which we have, large workforce, English speaking population. So the demographic dividend is yet to kick in for India, and we are very strongly believing that, that will change the entire growth trajectory for India, and India will continue to have that tailwind of growth which it has seen in the past decade or so. So and obviously the contributors, these are obviously the action or the reactions of that, that with the growth, we have seen highest ever GST collection, or, in terms of inflation is very macros. In terms of macros, you see high forex reserves. We are at a peak. In terms of our inflation, we are at a very comfortable position. And the way, UPI or digitization has, propelled the growth by itself in the country has been, remarkable. Uh, so in the next, and even the infrastructure spends, or, be it in terms of the household consumption, right? I mean, in terms of the pattern of consumption, we have seen that, people, I mean, there is the spending shift, which is and doubling of spending, in terms of consumer, where on an average, a family in 2009-10 used to spend about 930 rupees, which has gone to almost 2600 rupees on an average in terms of their compare urban households, compared to the rural spending pattern on the food and non-food categories. So in a nutshell, there has been change, there has been uplifting in, in terms of the quality of living, and as more masses, move, we always believe that India, though it is 140 crore, 40 crore plus kind of a population, this consumer base is limited to about 40 crore odd. We believe that in next 1 decade or so, there would be another 10 to 15 crore people who, because of the, age group, and it will shift and move into the next leg of, into this formal economy, and, will actually, support the domestic consumption itself. In our reckoning, uh, India can see we can see a major shift in terms of the per capita household income, which is right now a predominant chunk of that, lies below the $10,000, per household, household. We believe that that can, definitely move. That has a potential of moving upwards, and those are the trends which we see. When people ask that, what do you see from a long-term perspective, which will, continue, which will help continue the growth which Indian equities have seen. I think these are the reasons that we believe that the way the infrastructure spends, or the way the consumption domestically itself will, happen, or will unfold, will actually propel the growth for the Indian economy by itself. How do an investor capture? There are options of various products, but, at this point of time, we are here with a proposition of launching a large and mid cap fund. Helios as a house has launched already a flexi cap fund, which is 2,100 crores. We did BAF, Balanced Advantage Fund. We have launched one of our favorite theme called Financial Services. And we wanted to do a large cap fund because at this point of time, we were more comfortable in terms of valuations of large caps. And hence, because, we see, because the valuations are, sort of near its 15-year average, right, in terms of a 1 year forward basis. And, that was more comforting for us to look at this at this point of time. However, we were also cognizant of the fact in terms of the mid cap basket that, that there are select few caps, few stocks which have contributed to the excessive valuation or excessive, returns which mid cap, or the valuation largely, which mid cap, return is obviously a function of that, but, valuations which were looking at slightly on a higher side. We reckon, and this data, through this data, we are trying to explain that there are very select few stocks which have led to that. And those actually come from, some of the PSU baskets and all that. I think there is still a good enough number of or amount of market which is yet to deliver, which has gone through its own headwinds, and which looks still better placed at this point of time for us, while the broader market looks expensive. But there is pocket within that which can be a potential investment for us to look at into this fund. So we intend, why we chose large and mid cap when we wanted to do large, essentially is because of the structure of the product. That large cap uh, you know uh, constrains you with top 100 stocks, and hence largely the universe is very constrained. Whereas in the large and mid cap, we can actually have a 250 stock universe, right? And which is a broader universe for us to look at and identify stocks. And hence it makes sense, because from a longevity perspective of a product, when large caps are not doing well, you have a growth aspect, right? I mean, large caps are well discovered stocks in general, and thus there is limited potential for it over a long period of time to deliver significant and consistent alpha. But however, mid caps, which are the growth stocks, generally, I mean, growth which can provide higher growth, are the ones which you need, for you to build consistency in the product in terms of outperformance. And hence, there was a very strong case. Another thing is, the sectorial representation, the sector-wise representation. If you look at the, say, for example, if you look at the financial services itself, in a large cap, it is about 30%, whereas in a large and mid cap, it is about 24%. So it sort of gives you a leeway in terms of in terms of mixing the sectors also well in the product. Other than that, what we have noted is that large and mid cap, while it has outperformed the large caps, right, and it has also outperformed the broader market index, its volatility is which is measured by standard deviation, is tad bit lower than that of even mid cap single-handedly, and the flexi or the large cap, right? So even large cap has a higher volatility than the large and mid cap. So less volatility, and if you look at the rolling returns, it has significantly outperformed both the broader index and the concentrated index. When I'm talking about broader, which is represented by Nifty 500 TRI, and the concentrated is Nifty 100 TRI, we see that on a rolling basis it has outperformed, while it has started but underperformed the mid cap in single-handedly. But mid cap is slightly volatile, the risk is higher there, whereas this, with a significantly lower risk, has consistently outperformed both large and the flexi cap. So it becomes a bigger proposition. And from our distribution point of view, we've also noted that this category by itself has grown in the last 4 or 5 years. It has grown multifold and has got a significant traction from the investors as such, and hence makes it a very, very strong case of a product category, which is what we followed. So 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 how do we select the stocks? Our philosophy is slightly different. We follow something called as elimination investing. Elimination, why elimination? Essentially because we believe that and it has been sort of covered in the book Skin in the Game by Nicholas Taleb also, that via negativa is less error prone and more convincing than via positiva, which essentially means the process of rejecting you basis the negative is more convincing, because the highest conviction, of people lies in what not to do. We will get into the detail in just a while, but before we move to that, let's understand that how the market is, right? So you know because that is the backbone of basically our philosophy. We reckon that this is a US data, but since we are talking of India, let's look at the 1 to 3 year period Indian companies performance. You stack up the performance of Indian companies in the rank of the best to the worst, from a year on year perspective. You will note that generally, in general, market is a average of the good and the bad. And if you see that half the companies largely outperform the market, and half gets beaten by the market. And if you note this column, which is the 150th, which is one third, right? So one third beats the market substantially, and one third gets beaten by the market substantially, right? Which is the 350th best, which I'm talking about. If somebody would have invested in this side of the market, he would have lost wealth at unprecedented level. However, if somebody was able to, catch hold of these companies, right, which are there, which has outperformed single-handedly every year, right, would have done massive outperformance over the index. It shows that if somebody was to do this, cumulatively would have done 228 times, which is a very, very, but it is it is in a nutshell, it is not possible. Practically, it's not possible to do this, because you don't know which one is going to be the 150th best company. How much ever somebody says that they know which is one, but it's very difficult to predict which is the next winner, right? So the entire philosophy focuses on not doing the obvious mistakes, which puts the company into this basket of the bottom one third. And hence, by following the method of rejection, you continuously strive to move your universe towards the upper side, which is of the 50th, 100th, or 150th best. You don't know where you will land, but your objective or endeavor is to not do the obvious mistakes. And what are these obvious mistakes? When Samir started, or formulated this philosophy, he identified 8 reasons, 6 permanent reasons. Largely, the 6 permanent reason I will read out, and then I'll dwell into each one of them. So 6 permanent reason, it could be bad theme, could be unfavorable industry dynamic, potential for disruption, and basically weakness in management or their strategy background, poor corporate governance, or low quality accounting. These are six permanent, sort of long-term factor, historic factor. And then there are two factor which takes care of the short-term or near-term thing, which is basically negative medium-term trigger. In most cases, the financial performance, or projected financial performance, the growth, and the EBITDAs and PATs and all that, and then the valuations which the market quotes for per rupee of earning. So let's understand whatever I spoke in last 5 minutes through these charts, in terms of why rejection. So say, for example, you take an example of a company. That company is run by a very good management, right? uh, the point is that, does that make that company good? The answer is no. It depends, right? I mean, it is not certainly, having a good management doesn't make a company good, right? Because company might be coming from a bad theme, or might have a very coming might be coming from an industry which is getting disrupted, or maybe it might have a poor corporate governance, which is there are many companies, I mean, it can. So it doesn't mean that good management or good product strategy will make a company good, or vice versa, that a company coming from good theme will make a good coming from a good theme will make a company good, right? But even 1 point, say for example, even 1 point, say a company comes from a bad theme, makes that company bad, because in the hindsight, that there are enough and more companies which do well, right? On an average, on an average of last 20 years, 221 companies have beaten the market. So you're not worried. You are only worried about not doing the obvious mistake. So you reject the companies generously, right? On these parameters. Say, for example, bad theme. right? So at Helios, we have like three themes largely which have worked wonderfully well in the last with PSUs and or maybe gaining market share. Also, the second is new to India demography or which basically takes care of the mass affluent consumption. And the third one is factor cost advantage, which is basically companies who are investing in rupee and earning in dollar, right? In a simple manner to understand. Now, these three themes comprises of the first one comprises of financials, largely BFSI, insurance, let's say,
Devi, your voice is cracking and the screen is also not changed.
for example, earlier days, they used to be SBI Bank, but
Devi, can you hear me?
uh, this bad theme slide is visible. 26 slide number.
Devi, hello?
Yeah, can you hear
Devi,
me?
can you hear me?
Yeah, I can hear you. Yes.
Yeah, your screen had not moved, has yet not yet moved, and your voice is
Which
cracking.
screen is not? Acha, reshare. Okay. Okay.
Your voice is also cracking. You're not audible for last 1 minute, 1.5 minute.
Okay. I'll just stop share and I'll. Is it visible now?
Uh, Screen is blank. Yes.
Blank.
Yeah, the old slide is there, still there. Slide 26.
Yeah, that's the slide I put.
Yeah, so your last 1 minute audio was not clear. The video has stopped. The video has stopped. It's not moving.
Is it okay now? Am I with?
Yeah, we can hear you and see you.
Okay. Yeah. Is the screen visible now?
Yes, investment processes.
Okay, good. So what I was talking about is I was saying that I was talking about the reasons that which are the themes generally which has got tailwind is essentially anything which is competing with PSUs or public sector enterprises in the olden days. If you see, there were only PSU banks, then then came private banks, PSU insurance, then came private insurance, and they gained the market share. Similarly, infrastructure space also there were companies which have come which have gained market share from so market share they have gained and they have competed they were competition to the PSUs, right? So there was money which was to be made there. And the second is basically new to India demography, which essentially takes care of the mass consumption, right, or mass affluent consumption, which are the sectors largely anything to do with say for example white good loan, NBFCs, largely gold companies, right? QSR, or maybe today's EdTech, or quick commerce, all these companies which are coming today, which sort of supports the mass affluent consumption are the ones which we sort of like in that theme. And the third one is factor cost advantage, essentially comprises of companies which manufacture or spend in rupee and earn in dollar, which is basically tech services, pharma and specialty chemicals, right? So these are largely the set which for so there is size of opportunity, and we firmly believe that the money is always made in under penetration, right? And we believe that there is still scope, as I spoke about in terms of India, that there is tremendous amount of growth opportunity. More people come into the consumption side, there is so there is still under penetration, and the money probability of making money is there, right, in that segment. So that is what we look at. So I was trying to say that these are the eight factors. So I was trying to explain that why we don't call anything good, because why good cannot be defined precisely is essentially because if you are a company from a bad theme, right? Even if your management is good, or you have a even if your management is good or your strategy is good, you cannot be a good company, because that doesn't make you a good company, because there is no tailwind in the industry, right? If you're coming from a bad industry, and even if you have a good management, it doesn't matter, because you will not be able to grow, and there'll be no money which can be made. Similarly, you might be a good company, but you are getting disrupted, right? There are in this, like today, autos are classic example. Earlier days, there used to be four two-wheeler manufacturer. Today, you see in the EV space, there are already 53 people. I met somebody in the auto ancillaries, business from Pune. And I'm told that there are 54 companies who are already there in the EV space. I mean, there are so many companies which keep coming. So I think the pool is not growing. It doesn't mean that EV coming, the person who's using the internal combustion is selling, and and going and rushing to, it has not been discontinued. So the market remains the same. Eventually it will grow. So the growth is not going to be 24x for the EV, right? I mean, it is what, the newer people who want to, buy new will buy that, right? So that way. So the point here is that good cannot be defined precisely, and thus we don't call thus method of rejection which we use. Apart of this, the second level of screening which we do is using, so the first level of screening is these top 6 point basis which we reject the companies, and we narrow down the universe. And the second level is basically the medium term triggers and unreasonably high valuations. Now what are the medium term triggers? Say, for example, there is a business or industry which is getting impacted by, say, a macro interest rate change, right? Or say, or maybe, the growth or the valuations at which it is quoting, doesn't justify the growth. So, we as a house don't follow extremes. So we call ourselves an extreme value investor, nor do we call ourselves as an extreme growth investor. We believe in growth at a reasonable price, right? And that is what our philosophy is. So we like growth. We do sometimes pay excess for growth also, but then growth has to be justifiable growth, right? I mean, it can't be, that you pay excess price for a growth of, less than that of normal GDP, right? I mean, if it's going to grow in single digit, you don't want to pay, 28 times. You will go and pay, a higher, for a similar amount of growth, or maybe slightly higher amount of growth than what the PE is, right? So that's the way we look at. So by narrowing down the universe, we get a universe of not bad companies, and then what we do is, this is the funnel which we use in terms of narrowing down the universe. And then we try to identify two kind of companies, companies where we have higher confidence in reasonable return. Now, this confidence comes essentially because these companies have got historic track record, they have delivered in the past. So thereby what happens is that the return expectations becomes reasonable, because there is no discovery element happening there. These companies are known to everybody. There is no re-rating element or surprise element at this point of time, right? So hence the return expectation becomes reasonable, but that alone will not help us beat the market. So you need another kind of company which we call as emerging good stocks, which we call as reasonable confidence in higher return basket, right? So these are companies where you don't find at the point of time when you are evaluating anything wrong in them. They might be new, to the listed space, but they are good. There is, I mean, on all the criterias which we have evaluated, and they can get re-rated. They are not researched or identified by many people, right? And but what happens is that you cannot go and invest a large percentage or amount on these companies. So thereby what we do is that we try to blend between both kind of companies. So the top notch, about, say, for example, hypothetically 10 stocks or 40-50% comes from the company basket of higher confidence and reasonable return basket, and the rest, comes from reasonable confidence and higher return basket, where we diversify investments between, with between 18, 20 stocks or more, right? In a hypothetical example I'm giving you, say if you're doing a 40 stock portfolio, you will do about 15 stocks from here and the rest from other, but you will build a larger tail, thereby diversifying your risk, right? Because you don't know which one is going to do well. You have, at this point of time, you have narrowed down the universe, identified the companies which have got potential to deliver excess growth, but the point is you don't know at this point of time which one will do well. Hence you're diversifying your risk between many companies. And then you are saying that, okay, anything can happen in this, in this way, over past so many years, we've been able to identify some of the good names, which are part of our flexi cap portfolios also. So that's largely how we do the portfolio construction, and that will be the same thing which we will do in large and mid cap. It is and the self discipline which we follow is that we don't call ourselves as a long term investor. We believe in a series of 1 to 3 year of holding and continuously reviewing the portfolio, and that is what is our philosophy in terms of portfolio management which we follow. And because our objective is to consistently outperform, and not to take a call on one particular stock and sit with it, rather have multiple stocks and build a good portfolio which can consistently beat the market, because ultimately we need to have consistency in the portfolio and deliver a risk adjusted return to the investor. That is the objective with which we will construct the portfolio. So the portfolio is, so why Helios? Essentially, Helios as a team, as we do only equity. It's one of the funds founded by fund managers. So the most stable team here is the investment team, right? I mean, that's generally you get to see that, most of the places, there is a change in the philosophy or fund management. It's essentially because ex manager managing the fund moving out. Here, we have not, the investment team here, none of them have joined only for mutual fund. They've been there with the organization for a long time. Founder has been into the equities for a very long time, and he's, it's a investment manager founded company. And second, vast experience of equities. We only do equities, so there is speciality. We don't do maybe or debt or credit or other products. We only do equities. So we've focused way of only tracking one segment of the market and only generating returns through equity investments. That's the objective with which we fund runs. And since we have limited number of funds, the focus is too high on outperformance, or ensuring there is a consistency in the performance profile of the product. And yes, and it is basically right now it is suitable for investors who are savvier in terms of, who understand the risk appetite of, who understand the risk of large and mid cap, who have higher risk appetite. It's suitable for them, who want to build long-term corpus through a portfolio of equity mutual fund. It's good for them. And yeah, so Alok Bahl is the CIO and Pratik Singh is the co-manager who will manage the product. And yeah, and NFO opens on 10th and closes on 24th. We look forward to your participation, and with this I open the floor for question and answer.
Pankaj, do you have any questions? Pankaj is, I think, logged out. So if I may ask one question, Devi, any distinguishing feature from the other large and mid cap portfolios in the market,
So
other than the investment process?
So I think the main the point of very important point from our perspective is our philosophy, right? Because we stand out on our philosophy. that itself makes a significant difference. Another thing is, while at this point of time, we want to run a true to label product. That is what we do across, product categories. And we want to, our endeavor would be to, while, the fund offers that we can go up to 30% small cap, I think, we would refrain by doing that. We would want to run it true to label large and mid cap with the kind of allocation which is prescribed in by the regulator, and then also sort of move the allocation as and when it is warranted by the market environment, right? So that's one of the things. So yeah, so right now, yeah, that's one of the differentiator. Otherwise, another point is the themes which we like, so so those are the things which will bring in the differentiation vis-a-vis others, that it is more than only index tracker product. It is more focused on sort of bottoms up stock picking and philosophy, and and managing a portfolio of, as and when the AUM grows, we will obviously have more diversified portfolio. But to begin with, you will have a slightly less stock portfolio. So I think these are the things which will make us different. Our ability to move around the themes, which is basically the sectorial locations or the market cap allocations, has been good in the past, and we would want to replicate the same in this product also.
So the portfolio will have approximately how many stocks?
So we would, largely try to do anywhere between 40 plus kind of, stock portfolio. Not that diversified, but 40-45 stocks, I think, should be good to start with. And then we'll see as and when, opportunities come in or money.
And the top 5 or top 10 would have how much weightage?
So top 5, top 10, it's difficult to say at this point of time, because that will happen over a period of time. But it will be a well distributed portfolio. So it is not going to be a concentrated portfolio, because we follow these so our starting weights are generally 5% in one side of one kind of a company, and about 2.5% the other kind of company. So you can expect that, if top 10 stocks, in that, by that calculation, will not be more than 50%.
What will be the lowest allocation in any stock in the portfolio?
So, so see, we start with 0.75 or 1%, but generally we do 2% kind of a allocation, to anywhere between 1 to 2% kind of allocation, starting allocation in a story where we in an emerging good company bucket. So that is what we
So you mean to say there will be hardly any stock with less than 1% allocation?
Not necessarily. When you're building position, you might have, something which can also, depending on what cash you might, sometimes it might happen that you might have a lesser number also. But, in general, if you are building position, we look at least 2% in, or maybe 1% at least in a company.
Stock and sectoral caps, upper limit caps.
In stock 10%.
And sectoral?
Sector, see, it toggles between 0.75 to 125 of the index based on manager's view. But we don't deviate too much from sector. Any sector which has an index weight of 2%, the manager can go up to 0% in that. Generally, these are the guidelines followed by the investment team.
And the tail would not be very large. That's what I understand from your presentation.
Yeah, tail would not, to begin with, it would not be large. Yeah.
Any other questions, friends? Can put it in the chat box, or I can ask on your behalf, or I can unmute you. So this opens on 10th October
Yeah,
and
this
closes on
opens on 10th
24th
October.
October. The SIPs are possible in the NFO?
Yeah. Yes,
500 rupees?
No, 1,000.
1,000.
Yeah. So there is a question how the
Yes.
fund manager is going to invest in these times. So our portfolio construction would anyways, depict that the valuations, because we are talking of, if you look at the investment philosophy, we are anyways talking about, sort of removing the froth, right? I mean, in terms of the medium term trigger, in terms of unreasonably high valuation, these are the short term impacts, which we are looking at or staring at this point of time, the valuations discomfort which is built up. But I have also shown data that large cap space is fairly, you see that valuations are fairly much better than the other market caps. And there are opportunities, so if we say, for example, we like, tech space right now, we like, maybe at some point of time NBFCs will be of, we'll look into those. So, these are the kind of sectors, which segments, of the market which we will look at. And our portfolio would definitely, because the money is coming into the fund, we will not take a cash call. We don't do that as a house, because if the money is coming into large and mid cap in NFO, while we understand that it is coming for, one, the house, the investment house and their style of investment, and second, it is coming to be invested into the large and mid cap as per the house's view. So we will definitely go and invest, within, maybe we take generally a week's time, within that time. And then subject to the valuation comforts and the story and all that. So, we would do that.
Would this portfolio have derivatives?
Sorry, no, only from a, not much, no delivery, no gold and silver exposure into this.
And no F&O also.
No F&O, yeah. Whatever is permitted for hedging purpose and all that, but we don't intend to do that. We want to run it true to label, yeah.
What kind of return can one expect in the next 1 to 3 years?
See, I mean, I think large cap space looks promising from here, and some of the select mid caps also looks promising. So I think, the return expectation, it's very, very, very difficult to define though, which I'm sure you would appreciate that you can't indicate any return in equities. But, in the past, it has outperformed the large cap and both the broader market cap index, the combo of large and mid cap. I think, the return expectation should be around that only, whatever has been the historic averages, of market. I think, people should expect around that. But indicating a return, especially at this juncture, is something which I would refrain by doing that.
At least share what kind of beta the portfolio will be maintaining, targeted beta.
See, we generally would want to have a slightly low beta portfolio, so you will see that our investments would be on largely on the low beta defensives, on the large cap side. I think that itself will, when we are talking of large cap, we are anyways talking of a slightly low beta kind of a portfolio at this point of time, right? And as time would warrant, then we would take calls, because it's not that mid cap will remain like this. At some point of time it will still become, and we are talking of mid caps, we are not talking of small caps right now. We are talking of mid caps, and the mid caps which will emerge and become a large cap one day. I think there are promising businesses in that segment also. So it's not that we're going to completely sideline that. We will definitely take call on that, but our endeavor is to run a slightly low beta portfolio at this point of time to begin with.
So somewhere in the region of 0.7 to 0.9 or even
That
lower.
will completely, that will come out, once you sort of construct the portfolio, right? I mean, it is too premature to talk about that at this point of time, because, every day we are seeing some kind of a, movements in the market also. So once I think the portfolio construction happens, then, the absolute number would come out.
So what is your house view on the markets for next quarter and two?
See, I think we from a long-term perspective, as I mentioned, we are bullish on equity. Short-term, there are pockets of valuations which are discomforting, but otherwise we are bullish on equities. There are pockets where you can still make money. There are segments which hasn't done well in last 2, 3 years, and as I mentioned, if we have shown in our large caps, especially hasn't done well, right? I mean, large caps have underperformed both small and mid caps. So there is scope in that segment is what we are trying to tell, that this is large cap. If you look at, there is massive under ownership in large caps, and our belief is that that segment should do well, and that should be the source of returns in the next couple of years or 3 years time. That should definitely be source of the return. Other part is that with the interest rate regime, or maybe expected change in interest rate regime, I think with the lag, the excess Ps, with the effect of inflation and reduced cost of capital and higher discounting, I think the excess Ps which has ballooned right now should sort of shrink, and thereby it will start looking over a period of time more attractive in our reckoning, because the discounting factor change towards southwards, you will see that change, it start becoming more reasonable. And then even if the companies were to do maybe this year or previous years kind of growth number, I think valuations eventually will start looking slightly better, with just because of this factor. Plus, obviously, the growth which will come from there, itself will add to it. And that is what our endeavor would be, to identify and invest in companies where the probability of growth is, also higher.
Yeah, as you rightly mentioned, Devi, that there are pockets of discomfort within the large and mid cap segment. The overall, outlook being bullish. So, what kind of portfolio P multiple at least you're targeting?
See, P's, so P's in general are higher. So, our target. I mean, it's difficult to say. It'll come out, as a percentage of what we are buying in the portfolio. But I think, P's in general are on a slightly higher side. Even if, you look at any cap of the market, it's in general on a higher side. So you can expect, right? I mean, look at on an average, on a 1 year forward basis, what we are looking at is this. So it should be somewhere at the somewhere falling in between in these areas. You look at, as we see, the trailing ones are everywhere. Look at the so it should be a blend of somewhere this and this, and on a forward basis, I think uh, should be anywhere between 20, 25 or 27. I think, it shouldn't precisely, it's difficult to predict right now, but should be, because it will be obviously on the forward earning basis. But right now, if you look at on a trailing basis, everything looks expensive. So on a forward basis, it should be slightly cheaper, right? Is what, and we would focus on building that kind of a book.
So, would you suggest a staggered investment or a one-time investment in this fund?
We're trying to build a large capish kind of a portfolio. I think, if you are also of the same camp of ours, that, large cap will do well, then you should do a lump sum. Right now, there is no point, staggering in that, but, it depends on investors' risk appetite. But our suggestion is, because that's the reason why we are bringing in the NFO. Otherwise, we ourselves wouldn't have done the NFO. We are not doing this for a gap filling basis. We genuinely believe that there is a story in large cap, and which can be captured, and hence we are bringing in this. So, our recommendation would be lump sum only right now, that, if you are coming into this fund, please come in lump sum.
So what is the fund house AUM?
So we are including PM. So we are like 10 months we have spent, and we are close to about nearing about 2,500 crores between our three products. The oldest product is FlexiCap, uh, which is just 10 months, in since launch, and we are 2,100 crores in that. That has grown slightly faster. For us, overall as an AMC, we would be, between our PMS, AIF, mutual fund and advisory as an AMC, we would be nearing $1 billion now, sort of.
But only mutual funds?
Only mutual fund would be roughly about nearing about 2,500 crores.
What has been the performance of FlexiCap in last 10 months?
So
Absolute returns?
46%, if I'm not wrong, 46% absolute.
Fair.
And even, BAF, which we have done, has done 11%, sort of 11% absolute in, we gave a call in financial services that has also done well. Yeah. BAF we launched in March, and we run a BAF, which is a equity plus arbitrage BAF. So we don't do debt or credit in that. That's also done well.
Any other questions, friends? I think most of the questions have been answered to your satisfaction. The ones that are there in the chat box and Q&A. Any other questions? In case you have, I can unmute you, so you can go ahead with your questions. How is large and mid cap placed in terms of valuation? There is a question in the chat box. Would
Yeah,
you like
so
to
that's
Devi?
the chart here. So 1 year forward basis, it's nearing, large cap is almost near its average. Mid caps, if you remove the select few froth, right? I mean, which we are talking about, you see here, which we are talking about. If you're looking at last 1 year, and if you're looking at the trailing of last 1 year, of mid cap, right, which is about 30 times, if you remove the, say about 60 stocks, then there is a big large pocket which has not done well, right? There are stocks which have fallen between 10 to 20% return also, right? And there is a large universe which has fallen between 20 to 50%. So they're only, and these are stocks, why it is looking, if you look at stocks like REC, PFC and all that, where they have gone up 100 160% and all that, but the growth has been only 70. So 160% kind of a return, but 16% can only be attributed to the earning growth, right? And that's the reason why it looks slightly even bloated. But otherwise, there are pockets which are still trading at a sensible valuation, which can be looked at. There are certain areas which hasn't done well, right? Like QSR and all, or the traditional consumer stocks and have not done well. So I think there is opportunity. So yes, in isolation, yes, mid cap looks expensive. I agree with you. It is expensive, but it is due to a certain pocket, which I named also. Some of these stocks which are because of that, it is sort of quoting at these valuations.
The great Devi, it was nice having conversation with you and going through the product. So
My
thank
pleasure.
you
My
so very
pleasure.
much. Thank you everybody for your kind patience and participation.
Thank you so much.
Let
Thank
us
you so
let
much.
us do the needful and give reasons for Devi to celebrate.
Thank you so much. And I really appreciate your time, guys. And, I look forward to you participating in our product and supporting us. And teams are there on ground. If there is anything, please do reach out to us. Feel free to reach out to us for anything. We'll be more than happy to assist and grow together with you all. Thank you so much for your time.
Thank you. Thank you,
Thanks,
Devi.
Shashank. Thank
Thank
you.
you,
Bye.
everybody.